We know in these times of economic uncertainty and with pressure on margins, upward volatility in the cost of a corporate overhead such as insurance is most unwelcome. That's why, after almost 20 years of a buyer-friendly insurance market, we want to forewarn you that the market is changing very quickly. In this video, we explain what has driven this market change, what we expect to be the most impacted risk types, and most importantly, how we can help you best overcome these challenges. Competition has been eroding insurers' margins, and low interest rates mean they can no longer rely on investment returns to offset the impact of poor underwriting results. 2017 was the costliest year on record for weather disasters, and 2018 became the fourth costliest, significantly impacting insurers' and reinsurers' earnings, further adding to the targeted pressure we are now seeing for increased rates. Lloyd's losses in 2017 led to a mandated performance review by the corporation to actively address underperforming classes. This, followed by losses in 2018, has put further pressure on available capacity. Beyond the traditional types of losses impacting insurers, they now need to fund for new types of claims, most notably from data breaches and cyber attacks. Although insurance is a regulated industry, insurers aren't governed in terms of what they charge or who they are required to offer cover to. As insurers have become refocused on profitability, we are now seeing a number of corrective trends in the market. So the supply versus demand paradigm is now firmly in the insurer's favour. This changing market is different from the last one, in that to date we aren't seeing insurance costs increase universally. Instead, the pain is being felt either by certain industry sectors or product lines. Two industry sectors are feeling the most pain. Firstly, food and drink. Due to the prevalence of combustible materials used in processing sites and the frequency of large fires globally, for those heavier types of risk, we are seeing property and business interruption rates increasing dramatically. There is also a lack of insurance capacity for the largest exposures. The other sector is waste. The frequency of fires associated with this sector has turned off the market, leaving only a few specialist providers to the detriment of competition. As well as property and business interruption, we are seeing other product lines under scrutiny. As Lloyd's has traditionally written a large proportion of professional indemnity risks, their back-to-profit initiative is impacting pricing and capacity. Those companies involved in design and construct are feeling the greatest pain due to the well-publicised issues around cladding. Corporate failures and scandals, along with subsequent class actions, mean that directors' and officers' liability policies are now being called upon more than ever. An increase in corporate fraud and social engineering has put crime policies, which were rarely called upon previously, now under the spotlight. Marine and stock throughput, driven by an increase in large global marine losses. Global natural catastrophe risks, due to the increased frequency of major weather events. The high number of business failures have also impacted heavily upon the credit insurance market. If you don't operate in these highlighted sectors, or these covers aren't material to you, please don't think you will be immune from this sudden market change, as in general the market is pushing to restore technical pricing. Challenge your broker team, who know your risk and how well it is performing, about what to expect. This will avoid any last-minute shocks and allow you to manage internal expectations. We would encourage you to start the renewal process much earlier than the soft market has previously required. This will give your broker team the extra time needed to negotiate the best terms. More importantly, this will also give you the thinking time needed to consider alternative solutions, such as different bases of cover or increased policy retentions. Carry out the risk improvements insurers have requested and have all the information you are likely to be asked for ready and to hand. Be prepared for a much higher level of insurer intrusion than you may have enjoyed in recent years. As there is a focus on quality, you will be best served in conveying the positives associated with your risks, whether that is loss record or risk management standards. To realise the best cover and pricing, you need to be prepared to disclose far more detailed information to insurers. Don't always assume that long-term agreements on policies make you immune from this changing market, as often in the small print the insurer can escape from their commitment to rating if reinsurance costs have risen. We look forward to meeting you to discuss how Aon can help you navigate these changing market conditions.